So focusing on this concept of tax haven or anti-tax haven legislation, what exactly is it, what's the nature of it, and what are the negative consequences not only for your members, but for the states themselves when they try to pursue that legislative fix?
These tax haven proposals would have a significant impact to our member companies and also to the state economies themselves. Let me explain. First, a tax haven list assumes that all business activity occurring in these countries that a state deems a tax haven, these bills assume that all that activity is abusive activity. And so whether you're operating there for hundreds of years, whether you have heavy-duty manufacturing, whether you have 1,000 employees in that foreign jurisdiction, because that foreign jurisdiction is now deemed a tax haven by a state, your company is going to be subject to punitive taxation, just like if your company only had a P.O. box in that same jurisdiction with one employee. So these tax haven lists, it's a blunt instrument, it's arbitrary, that affects all legitimate business activity, and that's a key concern for our member companies. From a state perspective, if you think about it, these proposals really do set up barriers to foreign direct investment, and let me explain why. If you're a global company, let's say based in Switzerland, which several states have categorized as tax havens, and you want to invest in the United States and build, let's say, $500 million new plant, are you going to locate that plant in a state that would immediately subject you to additional taxation simply because you have an operation in this foreign jurisdiction? You may or may not take that into consideration in your investment, but when 48 states do not impose punitive taxation because they do not have tax haven lists, then that could become a key consideration.